Bond king Jeffrey Gundlach told investors to buy TLT, preparing for the significant loans default recession. It's been 2 back-to-back days that I have seen long bond TLT and dollar DXY rallying, while the stock market is selling off, especially when you see oil is selling off with Dow Jones on Wednesday. That is a sign of deflation. This explains why TLT has retested 100 and moving higher now. There is one guarantee in an investor's life: the Fed not forecasting a recession. In the recent FOMC Fed minutes, inflation was mentioned 91 times. Interest rates were mentioned 24 times. Guess how many times recession was mentioned? Just 4 times. Yield curves are deeply inverted, as it has 100% rate of guaranteed a recession. Yet right now, no one is talking about it, but the market is showing it pretty obviously. They are all talking about AI this and Chat GPT that. It's kind of like a cat and mouse chase. Eventually, you are going to get caught. But it's probably nothing happening today. Why we are only at return to normal stage. We have yet to see fear, capitulation, and despair stage yet. So it's good to be prepared. Why Jeff Gundlach told investors to buy TLT, preparing for the significant loans default recession. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? U.S. Red Book Retail Sales Index has been falling back to the pre-2020 levels, which is the historic average. However, in 2019, we were going into a recession even if nothing had happened. Today, we almost have 5% Fed funds rate and 7% mortgage. What could go wrong? Jeffrey Gundlach has raised the alarm on an impending U.S. recession, warning investors they need to prepare for it regardless of how severe it ends up becoming. Gundlach, whose nickname is the Bond King, is a billionaire, investor, and the boss of Double Line Capital. He warned stocks may come under pressure, loan defaults might surge, and inflation could prove stubborn in a recent interview. Last year, he said that the Fed couldn't possibly raise the Fed funds rate to 5%. Yet, because of China's reopening and the recent jobs and unemployment number, 5.35% is what the Fed has been talking about. However, we will have to see if that actually happens or not. Moreover, he cautioned that attempting to forestall an economic slump can result in a far more devastating downturn in the future. It doesn't matter if it's a soft landing, or a hard landing. As long as we're going into a recession, you have to have certain degree of protection. It won't matter if it's raining a half an inch an hour or raining 2 inches an hour. In either case, you will need your umbrella. We could see some real interesting, painful outcomes that are coming in the next recession, whether it's very severe or not. Gunlock warned that tighter lending standards, a weakening economy, and low credit quality could lead to a spike in loan defaults. In spite of the fact that inflation is going to be reluctant to come down, I just think the shape of the yield curve is the best indicator of the forward economy. Gunlock said the curve, which plots the yields on bonds of different maturities, was absolutely predicting a recession. The one indicator that is the slam dunk on recession is if the unemployment rate crosses its 3-year moving average. We're pretty far from that. But if that happens, it suggests you're in more of a hard landing type of recession. What a lot of amateur investors don't understand is that markets often change direction at year end. It's not because of some strange astrological phenomenon. It's because of flows. It's not surprising that the Nasdaq, which was the dog of 2022, turned into the hero of 2023. I think the stock market is in a protracted bear market. When you have rising interest rates against these valuations, it's very negative for the stock market. When you have this sort of attempt to never have a significant downturn in the economy, Fed to the rescue, zero interest rates, quantitative easing, what you're trying to do is avoid any type of hard landing ever. But that type of activity violates Gunlock's rule of financial physics, that the frequency of problems times the severity of problems equals a constant. So the more you try to reduce the severity of problems, you're going to end up ultimately having a very high severity problem. If you have watched my last video, you will know that Russia's oil sales to China have hit their highest level since the start of the war. Russian crude and fuel oil flows to China rose to 1.66 million barrels a day in January, up from 1.2 million December. This implies why oil price is going to decline in the coming months. For China has been building up a very high inventory of oil reserve. US is already slowing down. Consumers are spending on their credit cards. That's not going to last long until they are running out of credit, as more companies keep on letting people go home. Oil demand is decreasing. That's good for the price of TLT. Two important pieces of data came out this week that are bullish for TLT. On February 16th, the Philadelphia Fed Manufacturing Survey for February was released. The official press release said, the diffusion index for current activity fell from a reading of minus 8.9 last month to minus 24.3 this month. Its sixth consecutive negative reading and lowest reading since May 2020. The survey, conducted each month since May 1968, is the oldest among the 12 Fed banks monitoring regional manufacturing activities, and is often viewed as accurately reflecting the pace of growth in manufacturing normally, because the data span more than 50 years. The index reliably provides an early indication of whether the economy might be slipping into a recession. The Philadelphia Fed asserts that its survey leads other indicators by weeks and correlates strongly with lagging indicators, such as employment and industrial production. Here is a chart of each monthly reading since the inception of the index in 1968. The most recent reading was a decline of minus 24.3, denoted by a horizontal black dashed line on the chart. Note, the vertical red shaded areas denote recessionary periods in the U.S. A few interesting observations from this chart, and the most recent reading in particular. In 6 of the 8 recessions since the 1960s, when the index fell to minus 24.3 or lower, the U.S. economy was already in a recession. In the 2 instances where this was not the case, September 79 and January 01, the U.S. economy entered a recession, 4 months and 2 months later, respectively. This week's second piece of important data was the Conference Board's leading economic index, LEI, released on February 17th. As the name would imply, this index looks at 10 different components that the Conference Board believes are predictive or leading with respect to the direction of the U.S. economy. The LEI fell by minus 0.3% in January, following a decline of minus 0.8% in December. The LEI is now down 3.6% over the 6-month period between July 2022 and January 2023. A steeper rate of decline than its 2.4% contraction over the previous 6-month period. The U.S. LEI remained on a downward trajectory, but its rate of decline moderated slightly in January. Among the leading indicators, deteriorating manufacturing new orders, consumers' expectations of business conditions, and credit conditions more than offset strengths in labor markets, and stock prices to drive the index lower in the month. The contribution of the yield spread component of the LEI also turned negative in the last 2 months, which is often a signal of recession to come. The Conference Board provides the following chart with each release. Note where the current reading, January 2023, is relative to the recession signal in red. Don't be fooled. Look at the Wall Street cheat sheet. I think that the market highs of early 2022 might align well with the new paradigm peak on this chart. Right now is classic back to normal stage. And here is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel, and it is about the stock market. So amazing, this one. So you want to order your copy today. And my book time. You are such a good boy for watching my video right till the end. Bye.